A little bit about ourselves and myself first. I founded this firm 5 years ago. I previously was head of real estate mezzanine at Barclays Bank and then in the investment banking division, and afterwards in Orion Capital Managers, which is a pan-European real estate private equity firm focusing on the UK and Germany. And when I started out, there were two things in my mind. I wanted to help investors raise debt that is in line with their requirements, professionally negotiated alongside lawyers, but very focused on the commercial side, and also put deals together. And we do this in 4 countries, which we can manage very well: UK, Germany, Netherlands, and Ireland. And I must say, if we say 4 countries, that's a little bit grand, because the beautiful country of Ireland for us consists of Dublin, so we have to be a little bit honest about when we say country level. And that works very well because on the ground, either we have private equity firms, we have fund managers who ask our services because they don't have the contacts, they don't have the feet on the ground, their office is currently a little bit understaffed, and so on, and we pull all this together for them. And in a very competitive market as it is, being able to source, structure and pre-analyze deals creates a lot of value. And here's the underlying reason, and Robert alluded to it. If you look at the 10-year government bond yields, it's very difficult for anyone to invest and really make money on the back of that. So bonds have driven money into all kinds of alternative investments, and real estate benefited from this greatly. The banks are also able to borrow at record low, and so lend at record low. And if you look at the financials and the lending markets throughout the 4 countries we're working in, it looks actually all very well. Unless you're in retail, then you have a bit of a challenge. Ireland, you see there's a logistics, a little plant growing. This is because it's a developing market. The Irish market is very much serviced from a logistics point of view out of the UK, and as long as free flow of goods maintains, it's going to stay like this, just for economies of scale. A few things clouded alternatives, because people in the lenders cannot always get their head around this yet. They're very clever people, but sometimes they need some time to adjust and understand how to finance a data center, for example, one of the things we're working on. And residential is for everyone and everyone's darling. That's why I simply, maybe a little bit flappy, put it in as a piece of cake. So that is very easy to finance. What has all this led to? And thanks again to Robert. Record low yields in prime offices. We do all sectors, but I didn't want to have half our presentation. I just wanted to focus on one sector as an illustration. If you look at that, you understand why capital flows go out of Germany, because in the home market in Frankfurt, everything is around 3%. You have to invest overseas even to make money there. And the interesting question we have, and that was one of the very interesting points, the differential between where you can borrow. You can borrow in Germany at unbelievable rates. We've seen margins of 70 bips and below. When I was a mezzanine lender, I wouldn't even have picked up the phone for such a margin, quite frankly. It's ridiculous. But the banks are under so much pressure because the European Central Bank has managed down the overall interest rate into an unsustainable territory, I would argue. And so the banks just have to live with this. Other countries offer more opportunities. I profess not to be a specialist on France or Spain. We have the language capabilities in the office, but for a variety of reasons, we have decided not to focus on these markets. Now have a quick look. Prime office yields around 3%. Rental growth only in one area significant, that's Berlin. So how to invest in a place like this is very, very difficult. And especially if you afterwards net initial yield as a fund manager, you still have your own cost. What can you distribute to your clients? And the German funds are suffering from this, and that's why they're going overseas. Irish market has recovered dramatically. Dublin has a red spot, and I said before why Cork has a black one. It's a fantastic city, but just not large enough. Netherlands also recovered fantastic from its very difficult time after the financial crisis. But again, here yields are a little bit higher. The Dutch have an interesting way of calculating yields. They have some attractive rental growth, but it's hit and miss, and this 39% is one deal, so I'd be a bit careful using that as a benchmark. And now we come to the UK. If we look at this, a very substantial deep market, and some rental growth, some rental weakening, but comparatively attractive yields. And that's the story I'm trying to tell today. You come from the overall global view, which Robert very kindly provided, then you look at the yields in that country, then you look at the cities that you're comfortable investing in, and then you look at the parts of the city that you think are going to go somewhere, and then you look at the asset. And that's exactly the road we travel down. The country allocation is typically decided by our investor, but once they have set out, we want to invest in the UK, Germany, Ireland, Netherlands, we start working with them and trying to identify the deal in this market, because I showed you before, at 3–4% yield, it's not about it's not about the country anymore or the market anymore. At that yield, nothing bails you out other than a really good deal. Yes, in Berlin you have some rental growth. You bought in shrewdly. At 13% rental growth, your 3% go 3.6 roughly after a year. Everywhere else, it's all about the deal. It's only about the asset. Sure, you want to be in a good market, but you see here, so some of the assets trade at 4%, some of them 4.6%. Shaftesbury Avenue, slightly interesting asset in a very good location in London, led to WeWork. How are you going to get your head around a covenant like that? And I would bet that future WeWork deals will have this question much more asked than now. They're operating enormously successfully in London, but we don't know, with a cash burn like they have, where this is going to go. Having said 125 is a good investment. It's a capable investor. I'm sure they have a capable asset manager, and that's what you have to have in the back of your hand, because if you bought at that yield and things topple over, you want to have someone who is very firm, anchored on the ground, and pick up the baby and put it back in its place, because otherwise it's going to get really ugly. This is a very important case study that I had a conference call at 3 o'clock this morning, and because it's not finished, I cannot show it to you. It's just a reminder. We got hung up on some legal details, but you can find stuff that you buy at slightly above half the pound per square foot rate in a good asset with enough problems. And that brings it to my end, and where I'd like to dock on to what Robert says. The capital flows will demand how much money goes there and set the price. But in this environment, different investors have very different appetites. And there will always be a niche for undermanaged, difficult assets that have potential, but just need to spend a lot of care, the money and the willingness to do something. This one is owned by a large fund who doesn't want to invest anymore in a small asset manager who says, well, I'm getting only half the profit of it, why should I do all the work? So they sell it out without having optimized it. It's about finding these opportunities. That's the only way you're going to make sustainable money in this market, and that's what we specialize in. Thank you.
Great.